Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets, EMEA and International Securities. It's Friday, June 19th, 2026, and joining Derek to pose some questions on the financial market themes for the week ahead is Nico Jan Thiesen, Global Client Sales. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Derek. How are you?
I'm very good, Nico. How are you?
Yeah, not bad, not bad. Thank you.
Good.
In this very busy central bank week.
Indeed.
So it has been very busy. We had RBA, Bank of Japan, Fed, Riksbank, Bank of England, SNB. And looking at what happened over the last days, big move in the dollar. Probably the Fed meeting was the most important one. What are your thoughts on the FOMC outcome, and especially rate-wise, what do you expect the Fed to do?
Yeah, I totally get the reaction in the markets. I think the dots profile and the median dot profile was really the clincher in terms of the market move. And since the dot profile began, the first one was published back in 2012, we've never had a bigger shift from one publication to the next in terms of moving from nobody expecting a hike in the March dot profile to 9 expecting a hike in this one. So it was a dramatic shift, and I think that certainly spooked the market. Kevin Warsh himself, he clearly doesn't like forward guidance, and he didn't give a dot in the profile. So and the statement was shorter, and he's launched these reviews of different aspects of Fed's functioning and policy. So we're in for some significant changes, but he kept reiterating the need for price stability and saying that the Fed would achieve price stability. So all in all, it was hawkish, but do we really believe, or should we put a lot of emphasis on the dot profile, which is probably going to be abandoned relatively soon? And was that dot profile shaped in any way by the fact that there was a change in leadership? I certainly think there could have been an attempt to send a message that it's the whole FOMC, and in that sense, we're still back to, I guess, the data going forward, and ultimately inflation and the labour market. And it's our view that inflation has in or around peaked, and through the rest of this year we should see some disinflation in the annual rate as the energy drop feeds through, but also OER corrections weaker, and the tariff impact from last year also kind of falling out of annual rates. So I think inflation drops back. So I don't think we're going to get a hike from the Fed. So in that sense, I would argue that the upside for market rates is relatively contained from here, and therefore the scope for sustained US dollar appreciation is fairly limited as well.
If I just go back to remember from what the drivers you had for dollar weakness last year and then at the beginning of this year, a number of them are still in place. Maybe short-term interest rate differential in the short term help the dollar to rally a bit, but the other drivers, if you can elaborate on those, fiscal problems, etc., they're all pretty much intact for longer term trend.
Yeah, and of course, I think that the interest rate differential driver that's helping the dollar will peter out. But then I think, yes, the other factors that we've mentioned, fiscal uncertainties for sure. Like obviously you've got the cost of the conflict, but not just the direct cost, but also the fact that we have higher inflation. Therefore, we've got higher yields and higher financing costs. And ultimately, that deteriorates the fiscal outlook, which was already appalling based on the IMF projections, with the deficit running at 7-ish% through until 2030, 2031. Then on top of that, policy uncertainties, Trump unpredictability. We've got the midterm elections in November. The Republicans will probably lose the House. Will they lose the Senate as well? Trump is a kind of a lame duck type president in the White House. If they did lose both houses of Congress, could certainly create more unpredictability going forward in that context. And then, of course, this memorandum of understanding in relation to the ceasefire between the US and Iran. Iran is coming out reasonably well from this, and I don't think that's particularly favorable for credibility of the Trump administration as well. So, yeah, there are those other factors which I think certainly argues the case that foreign investors' appetite for hedging US dollar exposures going forward will still be pretty strong. Now, rates is obviously important from a cost of hedging perspective, but those other factors, I think, certainly encourage the prospects of renewed dollar hedging flows going forward.
Maybe if we, specifically in Europe, we have quite a bit of corporates that we're talking to. Eurodollar is for them, I guess, the main currency pair here. If I just look at the Eurodollar, we just talked about the dollar side. On the Euro side, we had the ECB chief economist coming out. That looks more like a potential additional rate hike as well, right? Saying the neutral rate is higher than we had previously been led to believe.
Yeah, I thought that was probably one of the most important central bank comments of the week, saying that the kind of high end range of neutral has moved up to 2.5%. So in other words, if they did decide to go again, they'd still be broadly in a neutral range. So the ECB obviously would be arguing that it's worth doing that as insurance against, the Middle East conflict re-escalating and crude oil rebounding again. And yeah, in that sense, I think it certainly keeps the prospect of another hike alive. The fact that they've gone once, they'd be reluctant to stop at one, because then it looks like a mistake. Even in the context of the fact that crude oil prices have dropped back down, if they're now saying, well, we're kind of still in neutral, they would argue that there's limited risks in terms of adjusting that a little bit higher from where we are now. So I still think they'll probably hike again, but of course, crude oil is still important, and if we continue to move lower from these levels, which I'd be surprised, but if we did, over the next month or two, then it could become more difficult.
Okay, then let's maybe move on to, of the corporates on the continent. Euro is their functional currency, so the euro crosses are relevant. Yeah. The dollar has strengthened against, at the moment, at least short term, against the euro. One of the currency pairs that everybody has in mind is euro yen, which has been more or less going up for many quarters now in the big scheme of things, and many have been waiting for euro yen to come lower. Now we have a little bit of a euro dollar correction to the downside. What is going on the dollar yen front? We're sitting at 161-ish, 161-ish. Is there a scenario in which we see short-term a euro dollar a little bit lower, but a dollar yen stable and an opportunity to get into, to hedge euros against yen? Or do you see what's the dollar yen view? here?
Yeah,
Where
well,
is
yesterday we got up to 161.81, so 14 pips from the high in 2024. So obviously the question is, are the MOF there to intervene and stop the level from breaking? And you've got to say, given the fundamental backdrop, given the rise in front end yields in the US, given the broad momentum for the US dollar, I think it's perhaps foolish to come in and intervene at these levels. So I think there's definitely a risk that they could stand back and allow this level to break and to move higher and maybe look at levels, I don't know, 165-ish, a break of 165 perhaps, something like that, where the short-term froth and speculative positioning gets even bigger, because it's certainly grown and there is that justification for intervention based on what the MOF and the government have said in the past. And the IMM weekly data has the leveraged funds yen short position now back at the same level as in July 2024 when they intervened, and we saw a bigger move to the downside for dollar yen for different reasons. So yeah, I think taking it to euro yen, Nico, in that context, obviously, I wouldn't expect euro dollar to be moving down at the speed in which dollar yen would be moving up if we break the high 61.95. Then I think we could certainly see euro yen go from 185 to 190-ish. You could definitely get that type of scenario. So yeah, if I was speaking to a client, I would say, look, I think there's a high chance we're going to get a pop higher in euro yen from here. And then obviously, further out, based on fundamentals changing, like what I said earlier about the US dollar and the Fed and rates, then maybe you could start to see euro yen turning lower.
Rates, Bank of Japan, what do we expect for the rest of the year?
Well, the yen has weakened obviously on the back of the rate hike that we got this week, which would imply disappointment in the markets and still fears of the BOJ being behind the curve. I don't entirely agree with that. If you look at spreads, like curve spreads, 2s, 2s30s, 2s40s and JGBs, we have seen a fairly notable reversal of the steepening. So the better stability and long-term rates would certainly suggest there's less fears amongst investors over long-term inflation, which of course would tie in with the fact that crude oil prices have dropped 30% in the last month or so. So I don't think the inflation fears is as high as they were before. And indeed, there was an element of hawkishness to the meeting, but I don't think it changes the dial in terms of the speed in which they raise rates, which is basically every 6 months roughly. So I think December, which is close to fully priced, is a reasonable timing for the next move. So we certainly shouldn't expect the BOJ to come to the rescue of the yen by being more hawkish or hiking more quickly. That onus is going to have to be with the MOF.
Great. Let's maybe move over to sterling. Important by-election. So Andy Burnham is now an MP. Is he going to be the PM?
Yes. Basically, in a nutshell, yes. He's stood in this by-election for one reason only, and that's to launch a leadership challenge to Keir Starmer. And I would expect that to unfold over the coming weeks and for that process to run through the summer and for potentially Andy Burnham to be in position for the party conference season, which is kind of late September into October. Keir Starmer says he's going to run. I think he might be thinking that now. I'm not necessarily sure that will end up being the situation. If a good majority of the cabinet are against him staying, the pressure will certainly mount for him not to run in a leadership election. If it becomes plainly obvious that he's not going to win, I think he could step aside. But then I think for FX and for the gilt market, it's back to credibility, fiscal credibility. Yeah. Andy Burnham has promised to maintain the self-imposed rules on fiscal spending. So if that's credible and if that's kept, then I think the gilt market can remain stable. But, you know, in the history of recent politics, you'd have to argue that there's a risk at some point there could be a wobble. Maybe some of the fiscal plans are, you know, lack credibility possibly, but I think there's definitely a danger there that we could get some political related kind of volatility. And that could certainly weigh on the pound.
And I mean, rates are up over the week in several markets, but sterling today, the yields are quite a bit higher, right? I think, what is it, 8-9 basis points?
Like there has been a reaction. I think maybe because of the scale of his victory. But you know, I think yields are higher everywhere. I think yes, they're a bit higher in the UK, but you know, we've scrapped our call. We thought the BOE would raise rates this year, but the meeting this week and the CPI data, the second consecutive weaker than expected CPI print, makes us believe that the Bank of England can probably stay on hold through this year. So that's good news. And in that context, it's a positive for the gilt market, perhaps. But I would still argue that euro sterling should be drifting higher. But we've been in this painfully narrow range. I was looking at 1 month implied vol, Nico, for euro sterling. It's like it's a smidgen over 3%. It's a record. It's close to a record low. But yeah, I think if we do get a move, I would expect it to be to the upside for euro sterling.
Okay, that's great. Well,
okay,
very good. Thanks a lot. And
great.
I think we've covered most topics of interest. And then have a good weekend.
Indeed. Yes. Thanks, Nico. Have a good weekend. Talk soon.
Good weekend.
Cheers.
Bye.
Bye-bye.
Bye-bye.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.